welcome to the Deep Dive. Today we're really digging into a fascinating market picture. Global indices aren't just climbing, they're hitting new records.
That's right.
So what's actually powering this incredible momentum? And I guess, what does it all mean for you? Okay, let's unpack this.
Yeah, absolutely. So our source today, our focus, it's squarely on the insights from ComSec TV's morning report video. This captures the market pulse right up to July 18th, 2025.
Okay.
And the idea is to pull out the really critical nuggets from that snapshot, give you a clear picture without all the usual noise.
Exactly. So our mission for you, the listener, is to really understand why global markets are hitting these, well, unprecedented highs. We want to dissect the specific factors at play and uncover what this powerful momentum truly signifies for how you understand the financial landscape.
Right.
So let's maybe set the stage with the U.S. markets first, because their performance has been, frankly, eye-popping. Major indices closing at record highs.
Yeah.
These aren't just good numbers, though, are they? What shifts in sentiment or maybe underlying health should we really be looking at here?
That's a really crucial point. There was definitely a significant shift in sentiment compared to the day before.
Right.
You had this earlier. Well, the report called it disquiet, related to some talk between the White House and the U.S. Fed, specifically about Chairman Jerome Powell.
Ah, right.
That seemed to be, largely put to one side. And the positive turnaround, it was driven by two main things: surprisingly strong corporate earnings and economic data coming out of the U.S. that was better than expected.
And the numbers certainly back that up. The NASDAQ, soared by 0.75%.
Yep.
S&P 500 gained 0.5%, and the Dow saw a similar jump, all three finishing at record highs. That's quite a synchronized leap, isn't it?
It absolutely is, yeah. And then if we look closer to home, our local share market, the ASX 200, it's actually set for a positive start, too, projected up about 0.4%. And that's adding to yesterday's gain, which was nearly 1%. So it indicates some pretty solid momentum carrying over.
And a key driver for that local momentum seems to be this growing prospect of lower interest rates, possibly sooner rather than later. That seems heavily influenced by what the report called a subdued employment report yesterday. Now, for our listeners, what exactly does subdued mean here for the job market, and why is that seen as good news for interest rates?
Yeah, good question. So subdued in this context, it basically implies the job market isn't, running too hot. We're seeing slower, maybe more measured job growth.
Right.
And that signals to the central banks that maybe inflationary pressures from wages might be easing up, which makes it more likely they can consider cutting interest rates without, fanning the flames of inflation again.
Ah, the Goldilocks scenario.
Yeah.
Not too hot, not too cold.
Exactly. Kind of the sweet spot for markets.
That makes a lot of sense. But okay, beyond these big economic currents, the real fuel, the engine for this rally, seems to be corporate earnings, right?
Definitely.
So let's pull back the curtain on some specifics here, because this is where it gets really interesting, I think.
Absolutely. Financial stocks, they really led the improvements. We saw better than expected earnings from what the report described as a broader footprint of organization.
A broader footprint. So not just one or two stocks.
Exactly. A wider range doing well. Take Citizens Financial, for instance. A significant regional bank in the U.S.
Okay.
They reported earnings of 92 cents per share. That comfortably beat expectations, which were around 88 cents. And it's a 12% increase compared to last year.
Wow, 12%.
Yeah. And their revenue was also stronger than expected. And crucially, their provisions for bad debts, the money they set aside for potential loan losses, that came in below what the market was bracing for.
Right. And why is that provisions number so important? What does it tell us when it's lower?
Well, lower provisions mean the bank thinks fewer people are going to default on their loans. It's a strong signal about the health of their borrowers and ultimately the economy. Plus, it directly boosts their bottom line, their profitability. It's like a vote of confidence.
Got it. So Citizens Financial shares were up?
Yeah, up around 4% on that news.
Okay. Who else stood out?
Then there's Travelers Corporation, major insurance organization. They also delivered better than expected earnings, $6.51 per share. And the key factor there was their investment income. That's the money they make investing the premiums they collect, often in the bond market.
Right.
That income was significantly better than what analysts were looking for. So their shares improved by about 3.5%.
It's fascinating how that investment side can really move the needle for insurers. Okay, shifting gears slightly. Tech space, digital assets also saw big moves.
Yeah, definitely.
Coinbase, for example, its fortunes are obviously tied pretty tightly to crypto. Shares were up about 4% last night.
That's right. And the trigger seemed to be the U.S. House of Representatives passing legislation aimed at creating a framework, some oversight for digital assets.
Now that's interesting. Why would creating oversight be good news for Coinbase? You might think more rules would be a negative.
Yeah, it seems counterintuitive, doesn't it? But for an established player like Coinbase, regulatory clarity is actually a huge positive.
How so?
Well, it kind of legitimizes the whole crypto space. It reduces uncertainty, especially for big institutional investors, and it can pave the way for wider adoption because there are clear rules of engagement. It moves crypto out of the Wild West phase.
Right, makes it more mainstream.
Exactly, which is what a major exchange ultimately wants. Oh, and related to financials, the KBW Bank Index, which had been down the day before, bounced back 1.2% last night, too.
Okay, good context. But the real showstopper in tech, arguably, was Taiwan Semiconductor Manufacturing Company, TSMC.
Oh, absolutely, the world's biggest chip maker.
Their Q2 numbers were what? Well ahead of expectations. Profit up 61% year on year.
Huge numbers, yeah, well ahead. Profit up 61%. But here's a really fascinating detail the report highlighted. Their margins were better than expected.
Better margins even with a flood of orders. Usually that kind of demand pressure can squeeze margins, can't it?
It often can, yeah. You might expect them to sacrifice some margin to meet demand or face rising input costs.
So what does that resilience tell us about TSMC? Is it operational brilliance, pricing power, or have they found some kind of cheat code?
Huh. Well, it's certainly impressive. It speaks volumes about their dominant market position. Better margins despite that surge in orders suggests, probably a couple of things. One, incredible operational efficiency, tight cost control.
Okay.
And two, significant pricing power. They're just so critical to the global tech supply chain that even when orders flood in, they can maintain profitability. They don't seem to need to cut prices. Their tech is clearly indispensable.
Right.
And TSMC's positive news was really important for broader sentiment in tech, especially because the day before, ASML, they make the super advanced chip equipment, had given a somewhat downbeat outlook.
I remember that. ASML stock took a hit initially.
Yeah, it fell by double digits at one point, though it recovered some ground.
Yeah.
So TSMC's strong performance really helped stabilize things and restore some confidence after that wobble.
And we saw those positive vibes spread, right?
Mm-hmm.
Other tech names like Marvel Technology, ARM Holdings, Broadcom, they all gained. Broadcom up 2%.
Yep, all saw gains. And even Oracle shares were up around 3%, apparently due to some analyst upgrades. It really does paint a picture of pretty broad strength across tech.
Okay, so strong earnings are clearly a huge part of the story. But you mentioned economic news also played a role.
Yes. Beyond the company specifics, we also got some economic data points that really supported the positive moves, sort of confirming the narrative of economic resilience.
Right, like the U.S. retail sales figures for June. They came in much better than expected. A gain of 0.6% versus forecasts of only 0.1%.
Exactly. And that's important because, as the report notes, retail sales figures feed directly into the GDP numbers.
So when we say it feeds into GDP, what does that stronger than expected number tell us about, say, consumer confidence right now? And how might that influence thinking about the economy?
Well, when retail sales beat expectations like that, it's a strong signal consumers are still feeling confident enough to open their wallets and spend. That's a huge chunk of GDP, right?
Yeah.
So this robust consumer activity suggests the economy has a pretty solid foundation. It might make policymakers like the Fed feel a bit less urgency about, say, aggressive stimulus and more comfortable with just a measured approach to interest rates. It just paints a picture of underlying strength.
Okay. And there was another positive indicator, too, something about unemployment claims.
Yes, the number of people claiming unemployment benefits for the very first time, it actually fell for the 5th consecutive week.
5 weeks in a row. That sounds significant. What's the sort of deeper message there about the U.S. job market?
Well, a sustained decline like that, 5 weeks running, it really indicates that layoffs are low and the job market is staying tight and healthy. It reinforces that idea that the U.S. economy isn't just growing, but it's doing so on a solid employment base, which, again, supports consumer spending and overall stability.
So if you bring all these economic pieces together, the retail sales, the jobless claims, what's the overall picture they paint? It sounds like encouragement that the U.S. economy is holding together pretty well.
Precisely.
Maybe offering hope that the employment picture stays intact, even with those background worries about, the tariff outlook.
Exactly that. These figures collectively kind of reassure investors that the U.S. economy isn't teetering on the edge of a sharp slowdown. While yes, the tariff situation remains a concern in the background, the immediate data points to surprising resilience. And that's why we're seeing such a strong positive market reaction.
And this positive feeling wasn't just confined to the U.S., was it? It spread. Europe saw a recovery, too.
It did, yeah. European markets had an encouraging recovery from the weakness they'd seen the day before.
What kind of gains do we see there?
The Stoxx 600 index was up 1%. The German DAX climbed 1.5%, and the French market did even better, up 1.8%.
And similar drivers. Tech earnings.
Yeah, much like in the U.S., the report highlighted better-than-expected earnings for tech stocks as being a key driver for those European improvements as well. Shows how interconnected things are, that positive corporate news has that global ripple effect.
Okay. And just for awareness, any notable moves in commodities we should mention?
Yeah.
Oil prices were up.
Yes, oil prices climbed nearly 2%. The report linked that primarily to attacks on energy infrastructure over in Iraq.
Right. And what about gold? Usually seen as a safe haven, but with markets rallying.
Gold prices were actually a little bit easier, as the report put it, so they fell slightly, down about 0.25% to $2,339 an ounce.
And why was that?
Largely due to a firming U.S. dollar.
Okay, explain that connection for us. Why does a stronger U.S. dollar usually mean slightly weaker gold prices?
Yeah, it's generally an inverse relationship. When the U.S. dollar strengthens, gold, which is priced in dollars, becomes more expensive for people holding other currencies. That can dampen demand.
Makes sense.
Plus, gold is often seen as that safe haven asset. So when the dollar is strong and overall market sentiment is positive, like we've been seeing, some of that traditional safe haven appeal for gold just kind of diminishes a bit.
Got it. And speaking of currencies, the Aussie dollar, where's that sitting?
Currently trading around 64.8 U.S. cents. The report suggests those softer local employment figures we saw yesterday have put some downward pressure on it.
Right.
Arguably establishing perhaps a new trading range for it, below 65 U.S. cents, maybe down towards just above that level.
Okay. So let's try and summarize the core insight from this deep dive then. We're seeing global markets hit new record highs, and it seems fueled by this really powerful combination of things. Robust corporate earnings often beating expectations. Surprisingly strong economic indicators, like those retail sales and jobless claims, and specific sector successes, particularly in financials, and definitely in tech with companies like TSMC.
Absolutely. And what's truly fascinating here, I think, is how quickly that contrasting sentiment, those earlier concerns we mentioned about the Fed or ASML, how quickly they can be just set aside when tangible positive news emerges.
Yeah.
Whether it's from individual companies or that broader economic data, the market's ability to just pivot on good news is really quite striking right now.
It really is. And, this raises an important question, maybe something for you, the listener, to consider as you process all this. Given this current wave of optimism, especially in those hot sectors like tech and financials, how resilient do you actually think this market momentum is? How well could it handle unforeseen future economic shifts or maybe geopolitical events that come out of the blue?
That's a great question.